Hi everyone, in this video we will be going over A-Level Accounting 2023 February-March paper 3-2. So this is the structured paper 3 which consists of 3 questions. All of them will be of 25 marks and we're also given a time limit of 1 hour and 30 minutes, which means that ideally we should be spending about 30 minutes in order to solve each question. And in this video as well, we will be attempting to solve this question under 30 minutes. Also, I will be linking down this question paper as well as the mark scheme in the description box below. So without any further delay, let's get started. XPLC started its information technology business on 1st January 2022, and its statement of financial position at 31st December 2022 included the following balances. So it's at the date of 31st December 2022, which means that all of these are closing balances. All right. Then we are told that the 5% debenture was issued on 1st July 2022. And remember that our closing date is at the date of 31st December 2022. So this debenture has only been used for the month of July, August, September, October, November, and December. So that's 6 months, which means that the interest will only be charged for these 6 months. So let's figure out the interest on debenture. That's going to be our debenture amount of 100,000 in this case. We have the rate of 5%, and we're only trying to figure out the interest for the 6 months. So that's going to be times 6 by 12, which results in the interest on debenture to be 2,500. Then we are told that the freehold property was revalued upward by 70,000 on 1st August 2022, and an interim dividend of 0.12 per share was paid on 1st October 2022. Let's figure out the dividend amount as well. This is just going to be the rate per share times the number of shares. We already have the rate per share to be 0.12. Now let's figure out our number of shares, or the number of ordinary shares. So this is always going to be the value of ordinary shares, which is 800,000, divided by its nominal rate, which is 2 in this case. So the number of ordinary shares is going to be 400,000. So that's 0.12 times 400,000, which results in the total interim dividend paid to be 48,000. Alright, then the market price per share at 31st December 2022 was 3.35. Let's have a look at our first question. We need to calculate to 2 decimal places the price earnings ratio. Okay, so this is just going to be our market price per share divided by our earnings per share. Now we were already given the market price per share to be 3.35 right here. But we do need to figure out the earnings per share. Now the formula for earnings per share is going to be the profit for the year divided by our number of ordinary shares. We already figured out the number of ordinary shares to be 400,000. Now let's figure out the profit for the year. So we were told that XPLC started its information technology business on 1st January 2022. So this is its first year of operation, which means that all of the opening balances will be 0. Now let's prepare just the column of retained earnings from our statement of changes in equity. So we first have our opening balance, then we subtract all of our dividends paid, add the profit for the year, and then figure out our closing balance. In this case, since this is the first year of operation, our opening balance is going to be 0. We just figured out the dividend paid to be 48,000, so that should be subtracted. Now we're trying to figure out the profit for the year. We are also given the closing balance of our retained earnings right here to be 24,000. Now let's write it in an equation form. That is just going to be 0 minus 48,000 plus profit for the year is equal to 24,000. This means that our profit for the year is going to be equal to 24,000 plus 48,000, which results in the amount of 72,000. Let's write it down. So that's going to be 72,000 divided by 400,000, which gives our earnings per share to be 0.18. Now let's substitute into our formula for price earnings ratio. This gives the price earnings ratio to be 3.35 divided by 0.18, which is 18.61. Alright, Now we just need to figure out the dividend yield ratio as well. So again, its formula is quite easy. It is just going to be the dividend per share divided by the market price per share times 100%. Okay, we have the market price per share to be 3.35, and we were also given the dividend per share in the question itself, that was of 0.12 per share. Let's write it down. Now the value for dividend yield is going to be 0.12 divided by 3.35 times 100%, which results in the value of 3.58%. Then we have our gearing ratio. So the formula for gearing ratio is non-current liabilities divided by our capital employed times 100%. Let's have a look above. So the ordinary share capital is equity, share premium is also equity, revaluation reserve is also equity, retained earnings is also equity, debenture is our non-current liabilities, and the bank overdraft is our current liability. So the only non-current liability in this case is the debenture of 100,000. Now for capital employed is just the sum of our equity and non-current liabilities. In this case, that's going to be the sum of these values. So that's 800,000 plus 60,000 plus 70,000 plus 24,000 plus 100,000, which results in the value for capital employed to be 1,054,000. Let's write it down. And this results in our gearing ratio to have the value of 9.49%. Alright, then we also have the return on capital employed, and the formula for return on capital employed is profit from operations divided by the capital employed times 100%. Okay, so we already figured out our value of capital employed to be 1,054,000. Now we need to figure out our profit from operations. But we have also already figured out our profit for the year. And remember that profit for the year is equal to our profit from operations minus any sort of finance costs. We have our profit for the year to be 72,000. We're trying to figure out our profit from operations. And the finance cost is going to be the interest charges, right? And the interest is only charged on debenture, which we have already figured out to be 2,500. This gives our profit from operations to be 72,000 plus 2,500, which results in 74,500. Let's write it down. Now our return on capital employed is going to be 74,500 divided by 1,054,000 times 100%, which results in 7.07%. This concludes the first part of this question. Let's move towards the second one. We are given additional information. The industry average ratios for 2022 are, for the price earnings ratio is 16 and the gearing ratio is 25. Now we need to analyze the performance of X PLC, comparing the results with the industry average in respect of the price earnings ratio. We've already figured out the price earnings ratio for X PLC to be 18.61, and we can see that the industry average is only 16, which clearly means that X PLC has a better price earnings ratio. Let's write it down. X PLC has a better price earnings ratio of 18.61 than the industry average of 16. And remember that the price earnings ratio is equal to our market price per share divided by the earnings per share. So for this ratio to be higher, either the market price should increase or the earnings per share should decrease. So market price per share will only increase if the investors have more confidence in the company that the company will provide a higher return for them. Let's write it down. This would indicate that the investors have more confidence in the company, and due to this confidence in the company, it might also indicate that the share price of X PLC has been overvalued compared to the share prices of other companies in the industry. Let's write it down. It may indicate that the share price of X PLC has been overvalued compared to the share price of other companies. Okay, so the question is of 4 marks, which means that we need to write down another point as well. Now, again, we can talk about a higher share price. We can say that it means that the investors are willing to pay a higher share price in the expectation of future earnings growth. Like I said before, they're just expecting a higher return from the company. Let's write it down. It also means that investors are willing to pay a higher share price in the expectation of future earnings growth. Okay, now for the second part, we need to talk about the gearing ratio. And the industry average gearing ratio is 25%, whereas the gearing ratio that we figured out was of 9.49%. And it's way lower as compared to the industry average, which means that our business or the XPLC can be perceived as a low risk business, since a low gearing ratio is associated with low risk and a higher gearing ratio is associated with higher risk. Let's write it down. So XPLC has a lower gearing ratio of 9.49% than the industry average of 25%. And a low geared business is perceived as low risk. And low risk means that XPLC can be expected to remain in the business. So this just means that the variation in their return to the shareholders is not much, which means that the investors can expect the same amount of return in the future years as well. Let's write it down. Low risk means that XPLC can be expected to remain in the business. And this is also the case because many of the businesses go bankrupt if they have a higher gearing ratio, which means that they have taken out much loan which they are not able to repay back. But since XPLC has a small amount of loan, it means that it has enough capability to repay it in the future, which means it can remain in the business. And again, we can relate it to the return to the shareholders as well, because higher non-current liabilities means that we need to pay out higher interest. But in this case, we have a low amount of non-current liabilities, so lower amount of interest will be paid, which means that more residual profit will be available for distribution as profits for the shareholders. Let's write it down. Low risk means that low fixed interest is paid, meaning more residual profit available for distribution to shareholders. Okay. Now this concludes the second part. We're again given additional information. One of the directors suggests that no final dividend for 2022 should be proposed. We need to advise whether or not the directors should propose a final dividend of 2022. So while investing in any sort of business, the shareholders have certain expectation to get something in return, and that return is basically the dividend. So if we're not paying out any final dividend, then it means that we cannot fulfill the expectation of shareholders. So final dividend should be paid in order to fulfill the expectation of shareholders and when we provide dividend to the shareholders will be satisfied and continue to invest in our business. And this also allows an opportunity for potential investors to invest in our shares at a higher price, which will increase our market price per share. So let's write it down. Final dividend should also be paid in order to reinforce the share price. Now we also know that XPLC only started its business in this current year, which means that rather than paying out dividend, it should gather the cash for more future development, right? Let's write it down. So business is still at an early age. So rather than paying final dividends, it should keep more cash in the business for future development. Okay, if you take a look above, we can also see that we are given a current liability of bank overdraft. Right here, that's a 14,000. This means that it is a negative cash balance. So this also reinforces our previous point that business is short of cash, so it cannot be able to pay any final dividend. Let's write it down. Business is short of cash to pay dividend. Now, based on these factors, we need to advise the directors whether or not they should propose a final dividend for 2022. Now, since the business is in a very early stage and there is shortage of cash, I would suggest the director to not propose a final dividend and rather gather all of the cash for any sort of future developments. Let's write down the decision clearly. The directors should not propose a final dividend for 2022. Okay, this concludes the third part of this question as well as the entire question number 2 of 2023 February-March paper 3-2. If you found this video useful, then make sure you like the video and leave a comment below, and make sure you're subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.